Okay, couple minutes past 11. So everybody, thank you very much for showing up to this. This is definitely a, I read something last night. Someone's in the waiting room. Let me let them in. I'm figuring out a lot of stuff too also, so. All right, so everybody can come in now. There's no more waiting room. We good? Yeah. I have one person waiting in the waiting room. Admit. I know. Yeah, I totally know that. So, okay, cool. So again, welcome everybody. I'm not going to mute everybody. If you have any questions, please ask. There's also a raise your hand button. Should be enabled as well, where you can raise your hand to ask a question. So yeah, we wanted this kind of be interactive. So any questions that you have, please. Let me find this little quote here. So actually, Remy, my daughter, told me this last night. I'm preparing for another presentation tomorrow. And she said that I told her, well, this is the new normal. And she goes, no, Dad, this is the new different, not the new normal. So, and that kind of resonated with me. So no in-person lunch and learns like we normally do, but we are 100%. We've been doing several different Zoom meetings, Zoom calls, Zoom videos, the whole 9 yards, and we're going to continue to do this to bring what we feel is valuable information to you guys, to help everybody out there in the real estate market to get out there, after COVID now and start rebuilding their business. I don't know about you guys, but it's pretty busy out there right now. So as far as rebuilding, I'm kind of questioning that because through this whole thing, we've actually been pretty busy. So today I wanted to chat with you guys and have a little meeting about credit and COVID. There is first of all, we always have a lot of questions about credit on a daily basis, and then boom, COVID hit. So how is that affecting our business right now? So we're going to touch base on that. But for the most of the presentation, we're going to talk about credit in general, okay? And please ask questions because like I said, on a daily basis, me and my team, we are getting questions about credit and why this and why that. Why are my credit scores so low? What can I do to get my credit scores higher? How do I handle this situation? How many points do I get hit when someone pulls my credit? So things like that we're going to go over today. So I have a good friend of mine on this call, and his name is Mark Teta. I've been doing business with Mark for many, many, many years, and he is an expert at credit. He is with Certified Credit, and he is going to take this presentation and teach us all about credit. And again, it's really good to know these things, so please ask any questions at any time. Does anyone have any questions right now in the beginning? Is that a no?
No.
We good? All right. So I'm going to turn it over to Mark. We're going to kind of go back and forth on this. So I want to introduce everybody to Mark Teta with Certified Credit, and this is our main credit reporting company who we use here at the mortgage firm. When we pull credits, when we dispute credits, when we do anything and everything, this is the company that we use. There's several companies out there that we can choose, but because of Mark and his service and his company, they provide just an unbelievably great service for us so that we can help you close more loans when we have credit issues. Okay, so Mark, welcome.
Awesome. Thank you so much, Patrick. I appreciate it. And I want to just say thanks to Patrick and his entire team. They're awesome to work with. You've got the best in the industry right here that is working with you as your partner and with us as our partner. And we're super excited to be on board and hopefully share as much helpful information as possible in these challenging and interesting times. And I'll just reinforce what Patrick said. We have been super busy and, have been over the last couple months. So with rates low and, things are rolling along, then we're just super excited to be, involved with the mortgage firm and working with Patrick and his team. So if you're ready to kind of start things off, Patrick, we can jump to the first slide and kind of get right into it.
Okay, great. And we also I have some of my loan officers on the call, I believe. I see Ron, I don't know if Mark Adwell, Jessica, Scarlett. So there's other of our loan officers here at the mortgage firm that are on the call as well. So if you guys want to jump in and ask any questions, please feel free to. Okay, guys? Mark, let's do it.
Okay, great. Let's get right to the first slide. So, there's a lot of interesting things happening with credit currently with the COVID situation and that type of thing, and we're going to get into that. But want to give you guys some basics, and I know that a lot of you have been in the real estate industry and mortgage industry for a long time, but we'll just touch base on a couple of things. So first and foremost, in particular, the mortgage credit reports that are run in order to underwrite or submit a loan to Fannie Mae and Freddie Mac are specific score models that come only to companies that are like certified credit. So we're a credit reporting agency. We're not a credit repair company. So we provide credit reports for the lending industry, mortgage brokers, bankers, lenders, that type of thing. And, what's interesting is there's so much information, which is awesome these days, about credit on the internet, TV. We hear it. I watch CNBC all the time. There's always, articles or news stories about that. But what I really want to key in on is, the models that are used on our credit reports are specific to the Equifax Beacon 5.0, TransUnion Classic 04, and the Experian version 2. So again, there's a ton of models out there. Some of the most recent information came out a few months ago about FICO 10. So there's FICO 10, there's FICO 9, there's FICO 8, there's, all types of different score models. And as you see on the next little section, consumer, so Credit Karma, they have their own score models and they calculate the scores just a little bit different, or they use the bureau information and they have their own algorithms that, which I think is a phenomenal tool. When it first came out years ago, I used to be kind of anti-Credit Karma, but I really feel like any resource now to help educate everyone on credit is really a positive thing. So I know the scores are generally different. That's one of the things Patrick and his team come to us, say, Mark, they've got a 780 credit score with Credit Karma. How come when we pull them, they're a 720 or something like that? So there are differences. And, annualcreditreport.com is another place to go to get a copy of your credit report. And what they provide you is the Vantage score, which is created by the bureaus, which again is just another consumer model. So when you're out shopping for a car, they pull your credit report, they get a car score model. When you're getting insurance on your car, your home, or even on mortgage insurance, there's different models that they use to develop that information. I'll correct myself because the mortgage insurance typically uses the score that comes on our credit report. However, with insurance, homeowners, car insurance, that type of thing, there's different score models. Bankruptcy attorneys, we actually have clients that are bankruptcy attorneys that get a bankruptcy score model on their credit report. So they're all very different. Nobody is right or wrong with the information. It's just when Patrick and his team pull these credit reports to pre-qualify your potential buyers, what's coming is the score models that are coming for the mortgage industry. So any mortgage company or bank or somebody is going to use those particular models.
All right, so I'm gonna step in here, guys, and if y'all don't have any questions, this is something that we get a lot of questions on. So reiterating what Mark is saying, Credit Karma is not the Bible for credit scores, okay? They are different. We notice in our industry that Credit Karma credit scores are always higher. They are always higher. And when we pull the borrower's credit report and they think they have a 750 and we pull it and it's a 650 or a 680, guess what? We get yelled at. We get screamed at. And, why? Credit Karma said this. So everybody, educate your borrowers. Educate people. There are different credit score models. Okay? Now, our model that we use is the Bible, okay, to get a mortgage, not anybody else's. So very important that you let your borrowers know that there could be a difference. So, you know, people want us to just to issue a pre-approval or a pre-qualification letter for a loan, and they don't want us to pull their credit because Credit Karma says they have an 800. We cannot do that. It's just, we can't do it. So we would have to pull our own credit report that Fannie Mae, Freddie Mac, Ginnie, all of these has, that we have to use to send out that pre-qualification letter or the pre-approval letter. So very important. That's one of the biggest questions that we get all the time.
Right. Yep. So we'll shoot to the next slide and then kind of just touch base on a couple of those differences that we've pointed out. So, you know, on the left, we have the Vantage or the consumer model, and on the right is the mortgage. You know, a couple things I'll just pick up right away is, you know, on our mortgage score models, you know, when you open a new account, you know, it generally takes 4 to 6 months for that to register and help with raising your score if that's what we're looking to do. You know, our score model wants to see history. So with the Vantage score, the consumer model, you can open up a new credit line, like a new credit card, and it starts affecting your score right away because that algorithm is not looking for history. So we want 4 to 6 months of history. How are you paying that card? Did you borrow money and are you paying it back? So a little difference there. You know, our credit scores penalize all late payments. So a late payment on a credit card or a mortgage or a car payment or something is a big deal. You know, on the Vantage or the score models, you know, they really kind of penalize the mortgage payments, but not, I mean, they do on the credit cards and the cars, but not as much. There's not as much emphasis. Like with our score models, missing a mortgage payment is a big deal. You know, that really deducts a lot of points because ours is really looking first and foremost, do you have a mortgage? How old is it? Are you current? And do you pay it on time? So one of the other things, the Vantage score ignores paid collections, where our score model considers all paid collections. And that's a huge deal. We get asked an awful lot of times, you know, hey, I hear medical collections don't affect your credit score. And if you'll see on the bottom of that slide on the left, ignores all collections under $250. A lot of these medical collections are under $250. It could be $50 or $80 or $100. Now, our score models, a $50 and $80 medical collection could absolutely drop your credit scores 50 or 60 points. So, you know, we're really taking into account on our score models. And again, our models, by the way, are 12, 15 years old. These models came out back when Fannie Mae and Freddie Mac developed their automated underwriting systems, the DU system or the LP system, if y'all are familiar with that. So just some of the differences between the Vantage score, the Credit Karma score model, if you will, showing you some of the reasons. And on the left, I mean, you know, Fannie and Freddie have considered adopting additional models to their underwriting systems. However, I think a lot of the things on the left-hand side really kind of are deterring them from doing that because, you know, a paid collection means that you had a collection. Yes, you paid it and that's great, but there should be some consideration in your score for that. And our score models really take all of that information into account. So just some of the differences, you know, some of the reasons why our scores tend to trend a little lower, like Patrick said earlier, than some of these consumer models.
Okay. And just one thing I want to reiterate on this one is late payments. A late payment is bad, period. A mortgage late payment is really, really bad, okay? So we typically cannot do a mortgage if you have been late on a mortgage in the last 12 months, okay? It's almost not 100%, but when we run you through our DU, our LP, which is our automated systems to get you approved, and it recognizes a mortgage late in the last 12 months, it almost always denies your loan, okay? I've seen a few caveats on a couple of them that it didn't. I don't know why, but that right there I call the kiss of death, is a late payment on a mortgage, okay? So very important. Don't be late on anything, but never be late on your mortgage.
So that's one of those things, Patrick, I'll just throw in some information that, you know, is a problem from an underwriting standpoint and a score standpoint. versus that medical collection that we talked about for 50 points, not a problem from an underwriting standpoint, but definitely a problem from a credit score standpoint.
Yes.
So we'll go on to the next slide. So what's in your FICO score? So payment history makes up 35%. The amount that you owe on your trade lines is 30%. Length of credit history is important. It's 15%. Credit use. Are you out applying for, I'm sorry, credit use would be your installment or your revolving accounts. So do you have a car loan or a student loan or a consumer loan where you're making a monthly payment, but they also want a mix of revolving? So our credit scores tend to trend higher for somebody that has installment loans as well as credit card accounts, that installment and revolving. And then the new credit is 10%. So are you out applying for mortgages? Are you out applying for credit cards or car loans? So when you have your credit pulled for lending purposes, whether it's mortgage, a car loan, it's something where you're borrowing money, those inquiries are hard inquiries, which generally deduct a couple of points from your credit score. So that's kind of important as well, and that's factored into that, complete 100% for the pie chart there. So that's really the components that kind of makes up to it. We've seen people that have great credit, but maybe not as high as they want, that only had a mortgage and like a student loan and didn't have any credit cards, or vice versa, somebody that had just 2 or 3 credit card accounts, but no installment loans like a mortgage or a car payment or a student loan or something like that. So they're really looking for that mix.
So one thing I want to note on this, look at the big, go back one, Mark.
Oh.
Do a curveball at you. You got to go back.
Yeah. I warned you about the technology part of that.
All right. So, and then if you want to go back to full screen. Okay, here we go. So payment history, 35%. Amount owed, 30%. Okay, that's huge. And that's why we are always coaching, hope that's the right word, or educating our borrowers that if you owe $1,000, that if you're allowed, and Mark, maybe you're going to touch this later on, I don't know. If you're allowed to borrow $1,000 on your credit card and you owe $999 on that credit card, that's accounting for 30% of your credit score, okay? So owing as much as you can borrow, or in some cases more than you can borrow, is huge on your credit report. So Mark has taught me, and I teach my clients that, and correct me if I'm wrong, Mark, but I tell everybody that don't go more than 33% of what you can borrow on a credit card. So you'll maximize your credit scores if you're allowed to borrow $1,000 and you owe no more than $333 basically. Then you'll maximize your credit scores and it won't go against you. Mark, am I still correct on that or close?
Yeah, you are absolutely right on about that. It's all about that utilization percentage. So the more maxed out, like Patrick's saying, you are, the less you're going to have a higher credit score. And that's one of the things that we key in on the most when somebody calls me and, hey, Mark, I need a few points on the score. What do you think? I look directly at, the credit card accounts and look for the balances. And, the closer they are to being maxed out, the more potential we have to move the score in a positive direction if they can make a payment. So, we could even pay it down under that 30% if we needed a couple of more points, or, but that's really a good rule of thumb, is that 33% to just kind of be consistent with. And, and that really helps. So credit cards are the fastest, easiest way to raise your credit score by paying down those balances. However, on the installment side, you really don't gain a lot by paying down extra payments or something, or paying off an installment loan like you would the credit cards. They give you a lot of flexibility for.
Good. Thank you.
So we'll shoot to the next one. We ready?
Yep.
Yep. Okay. So I kind of wanted to talk a little bit about the EXPERIAN Boost program, just because that's, we saw a new commercial yesterday with him and the purple cow. And I'm not quite sure who gives them the marketing advice on all that, but it's the wrestler, I think, John Cena and the Purple Cow that do the Experian Boost commercials. So a couple things. It sounds like a great program, and it really is for the consumer models. Experian Boost is a program that only works with your Experian credit score and your Experian credit report. So it does not really work on the mortgage score. It's more the Vantage score and the newer FICO models. What's happening is it allows you to take your mobile phones, your cable, your public utilities, trade lines that don't traditionally report to a credit report. And what it's doing is it's allowing you to actually sign those trade lines up to be auto paid. So you set it up on your checking account or your savings account. The money comes out automatically every month. And then that's how the company, it's called Finicity, that is the technology company that links the banks and the credit bureaus. So basically what you're doing is you're signing up your mobile phone, cable, or utilities for auto debit. And then what's happening is that trade line will show up on your Experian credit file. Patrick, you and the team may have seen trade lines that say self-reporting on them. And when you see those are these trade lines that are showing up from the Experian Boost program. Now, again, it sounds like a great program, and it is for the consumer score model, but it has absolutely no effect on our mortgage models whatsoever. So adding them may not improve your score at all. It's not going to hurt your score by having them. However, I will tell you, and I don't know about the mortgage firm and their underwriting department, but we work with a lot of national companies that have a problem. The underwriters have a problem with those trade lines being on the report because they're not traditional trade lines. So they're not really like a credit card or a car payment or a mortgage or something like that. So they don't really affect your mortgage credit score model at all. And on the consumer side, it's not helping your Equifax or TransUnion score. It's only helping your Experian score.
I have been seeing those show up lately, and thank you for clearing that up.
Yeah.
I guess it's not helping my borrowers like I thought it might have been.
Right. Yep. So, yeah. So just, kind of what's new and happening out there, and just kind of want to bring that information to the table. I'll talk just briefly about disputes, and, for everyone on the call, this is something really that, when a borrower is disputing an account that a late payment was showing up or anything at all on the account, it definitely can, it's another thing for us to deal with on getting disputes cleared. So in order for Patrick and the team to get a clear to close kind of thing, usually there can't be a dispute on a credit card account or a car payment or something like that. What happens with disputed accounts on your credit files, that they're not factored into the credit score. So what happens is it's only on the very first time that you dispute a trade line. They take it out of the score model because they're not sure if that's accurate information or not until they get verification back from the creditor. So once they do, of course, they clear the dispute and it goes back into affecting your credit score model. However, on the mortgage side, they know disputes aren't factored into the score. So if you have a file where maybe there's 3 collection accounts or derogatory accounts that have been disputed, it could artificially raise your credit score, and that's typically why we have to get those cleared.
Okay, everyone understand that. That's another big question in our industry. Disputes, whenever you dispute anything on your credit report, it takes it out of the credit scoring model. So now we're not getting a true and accurate credit score to do a mortgage. Now, old school, before Fannie and Freddie and underwriters figured it out, we would dispute everything and people's credit score would shoot up, would close their loan, and boom, everything was great. Fannie, Freddie, underwriters came out and said, no more. All disputes must be removed from a credit report, and then we repull the credit report to see what the true credit score is. And I know Mark will touch base on this later, but a lot of credit repair companies, they go in there and they dispute everything on the account. And when I pull your credit, it says you have a 750, but you have 10 disputes. When we remove those disputes, that 750 credit score goes down to like a 650, okay? Or it will drop. So we will educate and help the buyers with that. But please know that disputes are not good for us.
Mm-hmm. Right. You want to be careful going to the credit repair guys. You know, if you're in the middle of trying to do a mortgage, or you're thinking about doing a mortgage, or if you're a realtor and you're showing homes and that kind of thing, my recommendation is always just have them call Patrick and the team to have the credit file pulled first before they make a decision like going to see a credit repair company that could potentially cause problems. You know, Patrick and the team have been doing this forever, so they know the nuances and the little ins and outs on things that can get taken care of, and things that we've worked with them in the past on that we can get cleared up without sending them to a credit repair company first. And, you know, we may be able to set them up for maybe not a closing in 30 or 60 days, but 90 days down the road if they do this or that. So disputes play a big factor in that. And disputes were a big part of the 2009 financial crisis, of a ton of loans getting done and approved of people that were not in a position, really didn't have, like Patrick said, that 750 score, because they had so many disputes on the report. So that was a big problem. And, you know, that's something that we have to deal with. It's always great to have somebody have their file pulled by Patrick's team first and foremost, just to start working on these little things. And a consumer may think that it's something that's a big deal, and when they look at it, it's really not an issue, and we can get it cleared right up and move right along. So, you know, that's what a good partnership is all about, to deal with situations like the disputes. Any other questions, or we'll shoot on to the next one? Okay. So I'm just going to touch briefly on a couple of these next slides. So liens and judgments, you know, they were removed from the credit bureau information back in 2017. So no tax liens or small judgments show up on the credit reports. And, you know, this is more for the mortgage side. You know, these guys are very in tune and right on top of this particular situation. So, you know, what's really important is taking an application and asking the borrower, are there any tax liens or judgments or anything like that? What happens is, yes, they're not being reported currently on the credit report. However, lenders always order a fraud report, which is like a background check on the borrowers, and absolutely liens and judgments are a part of that report and will show up. So, you know, Patrick and the team are great at taking the applications and really talking to the borrowers to make sure, even with an 800 credit score, if they have a $10,000 judgment with a balance, that could be something that could be a hiccup and slow or stop the loan, you know, in the process down the road. So just kind of throwing that information out, and Patrick and the team are all over that and making sure that that's not an issue that's going to show up.
Yeah, and that's something we pull behind the scenes. It's called Fraud Guard on every single solitary loan. We do a credit report, but we'll also do a Fraud Guard. And if something didn't show up on the credit report, it may show up on Fraud Guard, such as a house that you owned that went into foreclosure 3 or 4 years ago that was in a bankruptcy, and it's not showing up in the credit report, and you didn't tell us that there was a foreclosure, we'll find it on a Fraud Guard, more than likely. So if you have any of your clients, or you know of anything behind the scenes, just mention it to us. A lot of times a buyer will tell us something, it's not on the credit report, and then guess what? It's not on Fraud Guard. So more than likely, we're okay. So we just want to know about it up front so that there's no issues in the end.
Yeah, definitely better to take care of it up front. So trended data was one. We'll kind of buzz through that as well. It's just an algorithm and some analytics dealing with the credit reports. You know, basically, I'll wrap this slide up really quick. It's always better to make more than your minimum payment on your credit cards than what the statement says. It shows that you're being a transactor, which is somebody who's being more responsible with their payments and handling their accounts. And that's a positive thing in the algorithms of the credit situation.
So Mark, $1 more will help you out?
Yeah, I mean, that's, you know, you're making more than that minimum payment. So, you know, whether the algorithm, I'm not 100% sure that $1 is better than $100 on that, but definitely you're making more than that minimum that it says. So it's showing, I think, the algorithm that's helpful.
Great.
So soft pulls, I just kind of want to mention that, you know, there's a lot of talk out there. A lot of the big nationwide refi companies do these soft pulls. You know, basically it's a quick, let's pull your credit report kind of thing. Some of them have scores, some of them don't. You know, some of them can be close to our mortgage score kind of thing. But, you know, a hard pull, which is what Patrick and his team are doing, where the inquiry shows up on your credit report, is absolutely 100% required to underwrite a loan through Fannie and Freddie. So, you know, don't get sucked into the whole, hey, I'll do your soft pull, you know, it doesn't show up as an inquiry and that kind of thing. And, you know, it's just a really kind of a quick snapshot type look. But if you're a serious buyer, a hard pull needs to be done. And Patrick and the team, you know, really can evaluate and let you know a little bit better. We've heard some information. Some of the accounts sometimes don't show up correctly on the soft pulls. So they're not really as accurate in some cases, not always, but in some cases, to where it might be confusing on, you know, them giving like an approval or, hey, you look pretty good, you know, let's kind of move on. So just, you know, the soft pulls are different from the hard pulls. They don't affect your, you know, your score, and they don't show up as an inquiry kind of thing. Could be your credit card company does. By the way, so when you have an account with a bank or a credit card company, they can go in and pull your file through a soft pull process multiple times to offer you increased credit limits or offer you points if you're Marriott or something like that. So so that's how they would do that, is to qualify you for their programs would be to do a soft pull.
And this does not affect your credit scores, correct?
It does not, no. No.
And the borrower doesn't even 9 times out of 10 know there was a pool, is that right?
That can be, yeah, absolutely. And which is definitely I think an issue and an eye-raising situation, because you never want to have your credit pulled by somebody that you don't know is pulling your credit file. For what purposes? For identity theft problems. You know, just be really careful. And like I said, a lot of the big national, you know, your Loan Depots or your Quickens or your Dytex, that they really just do refis, whoever's the cheapest, you know, whatever kind of thing, slam bam type deal. You know, they'll do these soft pulls kind of thing. So you know, it's just a little different. But always, even if they're going to do a loan, they're still going to re-pull your credit report, and it's going to be a hard pull with an inquiry that's going to show up, because they can't submit that loan to Fannie or Freddie unless it's a hard pull.
So we get this question all the time with people: is it going to be a hard pull or a soft pull or whatever? And it's and our answer is yes, 100%. It is a hard pull. Or, like I said beforehand, our credit report that we pull in the mortgage industry is the Bible. That's what we're going off of. That is the word. And so we have to do a hard pull to see exactly what's on there. So, you know, and then we can tell a lot of times under inquiries when we pull the credit reports. In fact, we know, I don't know if Mark, the soft pulls are in there or not, but we know everybody who has pulled that borrower's credit report because it's listed under the inquiries, and I think it's for 90 days or 180 days.
120 days on our reports, yeah.
Okay, 120 days. And Mark,
Right.
do the inquiries affect your credit score?
Yeah, so two things. So the soft pulls would not show up where you're used to seeing those inquiries if they've had a soft pull done. Inquiries stay on your actual credit file for 2 years, but this is again where the mortgage industry is a little different. We only are required to show inquiries for the last 120 days, because really Fannie and Freddie are looking to see, did you get your credit pulled and did you open a new account? They're looking for that information. And so yeah, so typically a hard pull is a couple of points off of your score. It's not a huge deal. And in the mortgage and auto industry, there's a 30-day window where you can shop multiple mortgage companies and have your credit file pulled several times, or auto companies and have your credit file pulled. You would get deductions for the auto and for the mortgage, but multiples under each category would count within that 30-day period only as one pull. Okay. So they know you're typically shopping, so you're gonna might have it pulled a couple times.
So Mark, is that, so if I pull a credit and then 5 other mortgage companies that week pulled the credit, let's say 10 other mortgage companies, should the reports be the same credit score?
Well, it depends. So because there's constant it'll be very close. Let's put it that way. The sooner the pulls are together, like if you did yours and then the next day 2 or 3 happened and then the next day, where you get differences in the scores, the time frame. So if yours was today and another mortgage company was 2 weeks, a lot of the creditors have reported their information. Your credit card company updated, your mortgage company updated. So when they pull it, the numbers are different.
Yep.
So the algorithm's going to calculate a different score.
Thank you for that. That's what the answer I was looking for. So
Yep.
we've had clients yell at us because, hey, my credit score went down or something. And then
Right.
I'm like, well, it didn't go down because I pulled your credit. It went down because in between when they pulled your credit and I pulled your credit card balance is now 5,000 when it was only 1,000. That would affect your credit scores, correct?
Right. And for everyone on the call, I'll just let you know that piece of information, that's Patrick and his team and his experience, because I do business with a lot of people in the mortgage business. And I can tell you right now, a lot of people don't know what Patrick just explained to those borrowers on why the differences in the credit scores. And they call us and we have to point that out for them. And I think, okay, something that probably you should know, but that's definitely the case. It's not the pull. It's, you know, you could have been late on your credit card, or like Patrick said, your balance is way higher now. And that's where you want that experience to be able to explain that to that borrower right off the bat, because that's a big deal. They want to blame the mortgage company when that score is low.
Yeah, and then if you guys out there, realtors, let your borrowers know that we have to pull your credit. Okay, we have to. And it's only going to count if maybe 2, 3, 4 points when we pull your credit. Okay, so we have so many borrowers that are like, I have an 802 credit score and I don't want you to ruin my credit. Okay, so you're going to go down to a 798 instead of an 802. Who cares? You're still top tier. Okay, it's still the best. So it's okay. Let everyone know that we have to pull your credit and it's not that big of a deal. Okay.
So Patrick, what is that magic number these days that if you're a 760, you get the best rate like you were an 800?
Yeah, great question. So on a conventional loan, we want 740 and higher. Okay. So if you want top tier pricing, you want, you know, just the best of the best, you have to have a 740 or higher credit score on a conventional loan. So if I pull your credit report and it's a score and it's a 740 or it's an 800, I don't care. You're going to get the same exact rate if you have an 850, an 800, or a 740. So once I explain that to the clients, they're like, oh, okay. But not everybody knows that. Now, there's other types of loans. So bottom line, the higher the credit score, the better interest rate, the better everything, okay? Now, with Fannie and Freddie, for every 20 increments that you go down in a credit score, so 740 and higher the best, 720 to 740, boom, you're going to get dinged a little bit on your interest rate. And then 700 to 720, you're going to get dinged a little bit more, all the way down to 620 is the lowest that we can do on a conventional on a conventional loan nowadays. Now, government loans are different. I mean, a 700 is a great credit score on a government loan. A high 600 is a great score on a government loan. You'll start getting dinged on government loans when I say 660, and when you get down to the 640, now you're going to get dinged with add-ons on your interest rate and possibly not getting financed, because when we do run you through the automated system, it's not just looking at income, it's looking at your credit. And if your credit scores are lower, you know, we have borrowers sometimes that have, you know, they make $200,000-300,000 a year and their debt to income ratio is really low, which is good, but their credit scores are low. So their loan gets denied because of their credit, even though they make $200,000-300,000 a year and they have $1 million in the bank. So it's a total package is what it is. So bottom line, higher the credit scores, the better, period.
Great. That's good information, because a lot of people get hung up on their 800 score kind of thing when, like you said, 740 is all really you need to get the best. So that's important. Okay, so we'll go on to the next one. So this is just some general information I'd just like to share about breaches. You know, there's been countless breaches of, big companies. I remember back in the day, Target was the first one, and it was, a big deal. And then Home Depot and Blue Cross Blue Shield. Then of course there's old Equifax that, they scrutinize, and boy, do they give companies like us a hard time. And man, they keep us under their thumb with, security and compliance and everything. And here they got, 147 million people had their information compromised by Equifax back in 2017. So, and then Capital One is another big one. The reason I emphasize this is I cannot stress enough about how important it is to protect your information and to be really, really careful. My company makes us go through trainings, security trainings every month. We have to log 2 or 3 hours. And when I first started doing it, I was like, I'm a sales guy. I want to be on the phone and in the car and out on the road doing sales, not learning, technology. Now, I so many times have not clicked on emails and have done things that could potentially compromised our company by not paying attention, or, it's just really gotten crazy. And especially now, it's even more so because everything is online. Everyone's buying everything online. There's, not much activity in person at the stores anymore. And, my mom was, the victim of identity theft when she was in the hospice program. And, because her file was, shoved around from so many medical people with her name, address, social security number. Your Medicare number is your social security number, if you could possibly believe that. So I can't stress enough, protect your information, because, the realtors are working hard to show, potential buyers homes and working on and getting pre-qualifications from Patrick and the team. And, one hiccup where somebody's identity is stolen, creates even more stress in this whole process and could slow things down. So it's just super important, be careful. Don't have the same passwords. Don't feel like all the things that you constantly hear, shred your statements, that kind of stuff is silly, because it's not, and it's really going to protect you. And I bring it up because I see people that have become the victim of identity theft in the mortgage process, and it slows things down. And like I said, it creates more stress for the buyers. So just, be super careful with your information. And that's really the extent of that slide, was, to talk a little bit about that. And then some of the protections that you can put in place to help yourself. So any questions on the breach thing before I get into a couple of the other things that might be helpful? No? Okay.
Guys, we normally have 100 questions when we do this
I know.
credit seminars.
Right?
We're gonna,
so, couple things. So like, credit monitoring is really important. There's a lot of companies that do credit monitoring, and what that is you've signed up with, I'll just use the one that I use, and I'm not promoting them. I'm not selling them. I'm not doing anything more than telling you the company I used was the least expensive option. So I use EXPERIAN, protect my ID through EXPERIAN and through AAA. I actually got a discount because I'm a AAA member through that. So what they do is they monitor your file, and they'll let you know when you have credit monitoring. If your credit file is pulled, you'll get an alert. And I think people have this with like Credit Karma and that kind of thing. So credit monitoring is basically anytime something's happening with your credit, I get updates that one of my balances went up, or, somebody's pulled my credit. My daughter moved into a new apartment out in Denver, and I had to be a signature guarantee, and, that kind of thing. So it's a way to monitor and to piggyback off of the breach situation, things that you can do to be aware, because typically somebody will steal your identity and then want to go and open up credit card accounts and get credit cards so that they can spend money. So if you can stop them from pulling your credit file, you're pretty much stopping them from stealing your identity, because if they can't have the credit file pulled, the credit card company won't open up a new account. So if you have monitoring, you'll get an inquiry alert that says, hey, somebody pulled your credit. You can immediately jump all over that and find out who it was, what happened, why did they pull it, and lock that down so that that doesn't go any further. Or you can do a freeze, and I will just caution everyone with a freeze. So I have my credit file frozen, and my wife's credit file frozen, and my daughter and my son. Where it works great is when I'm not out shopping for cars. credit cards, leases, or mortgages. And let me tell you, I'm in the credit business. So when we were doing the lease for my daughter, I had the hardest time unfreezing my credit. And all my wife kept saying is, how many years have you been in the credit business? Why can't you figure this out? So Patrick and his team have experienced people that have frozen credit files, and they get frustrated because you call and you say that they say it's unfrozen and it's not. So be careful. The freeze is a great way to protect yourself. But if you're thinking of buying or something, don't do it yet. Just wait. I mean, you can always freeze it and then temporarily unfreeze it. And they're getting a little better at that. You can plug in dates, you know, today's whatever, I want it unfrozen, and then automatically refreeze it next week. So I just caution those of us in the real estate and mortgage business, because credit is so crucial to moving forward with getting the loan. I don't want that to be a holdup, but it's a great way if you're not buying anything to protect yourself, because if your file's frozen, nobody can pull your credit report. And if nobody can pull your credit report, they're not going to open up new accounts on you without you knowing that. So I'm kind of overkill, and I'm a little conspiracy theorist kind of thing. So I have credit monitoring, and my credit file is frozen.
You're that client we don't like, because then we can't pull your credit, and we're waiting 2, 3, 4 days to get our real estate agents a pre-approval letter, and we can't because the credit's frozen, and then the buyers get mad at us because they said it's unfroze, but it's not, it's still froze. So yeah, but I think it's safe to do that, honestly.
Yeah. And again, if you're not buying anything, you know, it's a great way, but if you are, I caution you to do it. Took me 3 times with Equifax to do it for my daughter, and I was so frustrated. I think I made up some new cuss words in the process, kind of thing. So, so we'll move on to the next one here. So this is really just some general information about the 3 bureaus: Equifax, TransUnion, and Experian, and those are the 3 bureaus that we pull our, you know, files from. You know, in the mortgage industry, we use the middle score. We still get questions on that. So, you know, Equifax may be a 680, TransUnion may be a 720, and Experian may be a 700. The main reason for some of these scores being a little bit different is not all these creditors, your mortgage company, your car payment, your credit cards, not all of them all report to all 3 bureaus all the time. Your major guys report to all 3 all the time, but you could have a small collection company based in Tampa, and, you know, they handle collections on the medical side or something. They're a small company, so they may only be signed up with Equifax to send their information to, and not TransUnion and Experian. So when you pull that file and there's no collection from TransUnion or Experian for that account, your TransUnion and Experian scores are going to be way higher than your Equifax score. And that's one of the things where Patrick and the team, with their years of looking at these credit reports, can determine this bureau is only reporting that collection, the other 2 are not. So we may want to concentrate on one of those being our middle score to qualify this borrower for the best rate that we can get. And that's really crucial information, and crucial for understanding how the credit reports work. So, you know, the creditors, by the way, are charged a fee to report their information to the bureau every month. So Wells Fargo and Bank of America and Mobile, who have tons of money, pay the money to report to all 3. But the smaller creditors may only report to 1. A lot of courthouses, like the only public record information we see on the credit reports these days are bankruptcies. And even then, we only see a bankruptcy maybe sometimes on the Equifax file, but not on the TU or Experian file. And that really makes a big difference with your credit score. It changes it. So that's why the mortgage industry uses the middle score, because they know that there's differences with the reporting, and they're just looking for that middle guy.
And then just real quick
on that, yeah, please.
Understand that we 3 credit scores. We throw away the high, we throw away the low, and we use the middle score. It's not us to just pick and choose what we want to use. That is what we have to use. Okay. Now, why are there 3 different credit scores? Mark, tell us, why are there 3 different credit scores with 3 different companies?
Well, that's a really good question, Patrick. I'm not sure that anyone's ever asked me that before, but So I'm not really sure how to answer that question, but there's actually 4 bureaus. So one of them is CBC Innovis, and you may see that when you get like information from Bank of America or Wells Fargo or something, it'll show on the back page your information was obtained from Equifax, TransUnion, Experian, and CBC Innovis. But that one is not part of the mortgage industry, that bureau. So you know, Fannie and Freddie don't really interpret or look at that information. But I'll be honest, Patrick, in 27 years, nobody's ever asked me that question, and I don't have an answer as to why there's 3.
Yeah.
You know, and exactly how that works. So.
Okay, fair enough.
Yep.
So, okay, guys, so it's we got about 10 minutes so or left. Does anyone have any questions? I want to touch base on some COVID things that are going on right now. Okay, so if you have any questions, everyone know there's a group chat. I've been getting some different messages privately. So if you have anything publicly, please type it in there. What I want to go over is what I'm calling the, I don't know the right terminology, bottom line, forbearance. Okay, that's our biggest hot topic right now. Forbearance on a credit report. So forbearance, for those of you who don't know, with mortgage is right now through, you know, what has gone on with COVID-19 and 40+ million people losing their jobs. The government and mortgage companies and Fannie, Freddie have come out and said, hey, listen, you know what? If you're experiencing hard times right now and you can't make your mortgage payment, we're here to help. Okay? You don't have to make your mortgage payment for up to 12 months. Okay, now what the mortgage companies are going to do is they're going to take that payment, you're not forgiven for it, and they're going to put it on the back of your mortgage. Okay, so you may, and every company's a little bit different. If you do a forbearance for 6 months, you may have to bring current those 6 payments, and then you can extend for another 6 months. So in 12 months, you can put 12 months of payments on the back of your mortgage, okay? It's not gonna go away. You will owe it. You may or may not have to pay all 12 at one time or all 6 at one time, or you can just put it on the back, and instead of a 30-year mortgage, you now have a 30-year or a 31-year mortgage because they're gonna extend it, okay? Now, our problem is credit reports. When we pull your credit report, it'll state on there that your loan is in forbearance. There is no payment listed. Now, in the beginning, we had no direction on this. We now have direction. And the direction is that we can do a mortgage for you if your mortgage was in forbearance. Okay, so if you want to get a mortgage, you want to refinance, or you want to get a new loan, you have to bring that mortgage current. Okay, so if you're in forbearance for 2 or 3 months, you have to pay those 2 or 3 months, bring it current. We go to Mark. Mark calls the credit reporting agency, whoever it is, the company or the mortgage company, and they say, yes, he's no longer in forbearance, you're good to go. Then that has to be on the credit report. It'll say, and I don't know, like Mark said, I don't know how long this terminology is going to be on the credit report, but it'll say, borrower no longer in forbearance, we have a payment on there, and their payment is all up to date. Okay? Now, per the laws and the guidelines, you will not be reported late on the mortgage credit report. So Mark, being that there's no payment, being that there is a forbearance, is it affecting the credit score at all?
Yeah, so excellent question and great explanation. And currently, no, it's not. I mean, if you're in forbearance, and that's what, you know, the CARES Act is all about, is to make sure that the borrowers aren't being harmed that are in a position to be in forbearance. But no, it's technically not affecting your credit score at all right now.
Okay, now, it's not affecting your credit score. If you have a job and you weren't affected by COVID, you really shouldn't be doing a forbearance, okay? Because what's gonna happen, what can happen is all of a sudden these payments get thrown on the back, and then in 6 to 12 months, let's just say you didn't save for this, that rainy day or whatever, and now all of a sudden you can't catch up your mortgage. Then potentially the mortgage companies may start reporting you late after the forbearance. Maybe. We don't know yet. This is all new to us, okay?
Right.
So if you are affected with COVID, you lost your job, you can't make your mortgage payment, by all means, please do a forbearance, okay? But if you're not affected and you don't need to do a forbearance, don't do it, okay? Because it may or may not affect you at some point. Now, we're also seeing forbearances with cars, okay? We have a client that we pulled their credit report, and their cars say affected by natural disaster. It's forbearance. The automobile company said, hey, you don't have to make your payments. And a lot of times you have to be careful because a lot of our clients are inquiring about a forbearance. And next thing you know, they're in forbearance. They just like clicked a button and poof, they're in forbearance. And they're telling us, I never knew I did it. True or not, I don't know, but that's what they're telling us. So in that case with the cars, we ran into a situation because it is a business account that pays the car payment. And if we get 12 months canceled checks showing that the business pays the car, then we don't have to count the debt against you. Well, I don't have 12 months because it's in forbearance. So now we run into another problem. So if you don't need to do forbearance, please don't do it. But if you do, please do it.
And I'll just jump in there, Patrick, with some information that we're seeing. We talked about this yesterday. We had a client that had a borrower with Seacoast Bank. Same thing. The borrower was perfect, had like 815 credit scores, I think it was. I hadn't seen an 800 in a while, so I was impressed with that. But the borrower actually made more than his mortgage payment every month. So he was way current and, and then some. Well, when the client pulled his credit file, it said affected by natural disaster. Well, the underwriter immediately, got involved and said, nope, that's an indication that that person may have, and I use may have, filed for forbearance, inquired about forbearance, or any of the above. So we need to, just like Patrick said, my company then called Seacoast, gave the account number information, did what we call a supplement. So underneath the trade line now it says, we verified that this borrower has never applied for or is in the forbearance program, kind of thing. But that stopped that loan on an 800 credit score guy that had low ratios, was ready to go. So my point is, TV, and that's great that they're getting information out to the general public, but I'm just going to piggyback what Patrick said. And, if you're not being affected, you're working, you're making money and all that kind of stuff, be careful even calling your mortgage company to ask, because I've heard the same thing, Patrick, that one of the companies just put a ton of people into the forbearance program that just had called either to inquire about it or, how does it work and all this kind of, next thing you knew, they were in forbearance. And even though it's not affecting your credit score, it's one of those things that doesn't affect your credit score, but potentially could stop you from getting the loan. So it's, it's what's here and now, and it's evolving. And I think it's important, especially companies like the mortgage firm are so on top of this. We have other lenders I've mentioned earlier that are not always on top of this kind of stuff. So, it's really important. I know Jane, the underwriter, and all the main corporate people at the mortgage firm, and they're awesome. And they reach out to us for advice, and we bounce stuff back and forth just to see so that we're making the right decision for the borrower. But it's definitely a hiccup, and it's got to be handled correctly. Otherwise, it could potentially stop the loan from happening. And for all the realtors on the call, we don't want that to happen and then be out showing homes and that kind of thing, and then something like this be a hiccup for them. So.
Okay, so that's the forbearance. Let me know if anyone has any questions. Another topic that I want to touch base on is credit rescoring. Okay, so Mark has a great tool that we all use here, and it's called Wayfinder. Okay, or there's a what if. So if we have these situations or we have a situation where the borrower can borrow $1,000 on their credit card and they owe $1,000, their credit score is too low to get a mortgage, or their interest rate's high, then we do what's called a wayfinder. I don't know why they call it wayfinder. Do you know, Mark?
Well, it used to be called the Credit Analyzer, and I really like the Credit Analyzer name a lot better than Wayfinder, so I'm with you on that.
And then there's a what if. So what we
Right.
do is we pull a wayfinder, and it tells us if you pay down that credit card to $300, and you pay down this report to this, or if you pay off this, then you will get 8, 10, 15, 20 points, okay? Now, what we do at that point is we send this to the borrower, we have them do this, and then we repull their credit report and get higher credit scores, okay? So a lot of companies are doing this. A lot of companies do not want to do this and won't do it because it costs money. And in some instances, it costs a lot of money to do this. Now, when I redo a credit or when I do a wayfinder and we're doing a rescore, Mark, is it $20 or $30 per trade line?
Yes, it's $35 per trade line to do the rapid rescore. The Wayfinder is like $6 to run just to get an idea of what to do on the rescore. So definitely some costs involved.
It could cost us hundreds of dollars to rescore your client. Now, we do not want to do this, and we can't do it on every single loan. But if we feel that we have a good borrower who's going to buy a house and we can get their credit scores up, we go out on the limb and we pay that because, Mark, tell them, I can't charge.
Right. So the borrower is not allowed to pay for the rapid rescore. That's bureau compliance, and they're just being careful about that the mortgage company isn't charging consumers to do credit repair, more or less. Even though we disagree with that philosophy, we follow that philosophy. And yes, and that ends up coming out of Patrick's pocket when we've done rescores for $35 and I've done rescores for $3,000. So we do them all over the board, and it's an awesome program. And it's a great way to qualify somebody like Patrick is saying that maybe wasn't in a position before, or in that spot where we have somebody that's a 738 and we know we can get them to a 745 to get them that better interest or get them that better pricing.
Yeah, for sure. So we will do that for your clients within reason. If you have a 500 credit score, me doing a rescore is not going to help. Okay. Then you got to talk about potentially waiting and doing credit repair and stuff like that. I'm not a big believer of credit repair. I'm sure there's some companies out there. I've never had great luck with them. Me and my team here, we can look at a credit report and pretty much tell you what you need to do to raise those scores, and or let you know, hey, you're gonna have to wait 6 months, 12 months. I have found that one of the biggest things that'll help your credit scores is time, okay? No late payments, pay everything on time, pay down your credit cards, and give it 3 months, 6 months, 12 months. And you'll be surprised at the clients that actually listen to me and listen to us here. In 3, 6, 9, or 12 months, we get them into a house, okay? When we don't get them into a house is we tell them what to do, and in 9 months they call us back and say, I'm ready, I pull your credit, and you did absolutely nothing. It's not gonna help at all. So, okay, I am shocked we had no questions whatsoever. And am I missing anybody? I've unmuted everybody. Does anybody have any questions at all?
Is the PowerPoint deck going to be available?
Yes. Mark, can I share this?
Oh, absolutely, for sure, yes.
Thank you. Some companies don't let me share things. So
Yeah,
yes,
no.
we will share everything to you. This is a great information. So you will get a copy of this.
And I'll just, so throw in 2 more things on this one slide, Patrick, if we have just a sec.
Yep.
Just that annualcreditreport.com is a place to go to get a free copy of your credit report once a year from each one of the credit bureaus. The credit score would be a consumer credit score if you'd like that, but it's always a good idea if you're not applying for a mortgage or something, just once a year to have your credit file pulled through annual credit. It's a soft pull, so it doesn't affect your score. They will ask you if you want to purchase the scores. I mean, it's up to you. It's a consumer score, so it's not necessary. Where I'm going is pull your credit and make sure all those trade lines are yours and that you're not the victim of identity theft. And then the other one is the optoutprescreen.com. So that's a way to just get yourself out of the bureaus. All three bureaus have marketing programs where they sell our credit data to companies to market to us. Like Capital One is a big buyer of their information. So if you go to the optoutprescreen.com, you can get your name removed, or call the phone number to get your name removed from the list that the bureaus sell. The less your information is out there is where I'm going, the less you have the chance of being the victim of identity theft. I just don't like information being spread around and sold and that kind of thing. So then the other one is the do not call. So that's if you're getting solicited, do the do not call website or phone number so that you're not being interrupted at dinner with marketing phone calls and that kind of stuff. And just protect your information is what I want to close with. You know what I mean? Don't click on those attachments. Never put in your social anywhere other than the optoutprescreen.com website, because they will ask you for that to get you off of there. But just be careful. You know the old saying, if it doesn't feel right, it's not. So that's one of the things I'm sharing that I've learned from my trainings that they put us through here at Certified Credit every month. So
just a personal experience recently. I had an old Regions credit card that I never used, and it had about a $15,000 credit limit on it. I got a letter in the mail saying due to inactivity, they were closing the account out. And my credit score went from 816 to 803. It dipped 13 points just because of that little situation.
Yep. And that can definitely have an effect. If you have 3 credit cards versus 4 credit cards, that can make a difference, or 2 instead of 3. Definitely can make a difference.
Yeah, for sure. So, all right, guys, thank you all very much. We're just past an hour. If you have any questions, please let us know. Reach out to us here, and we'll be happy to answer any additional questions you have on the credit. This is all evolving, especially with COVID, and there's going to be some more things coming up soon. I never forget there was when short sales came out in 07, 08, no one even knew what a short sale was. There was not even a definition for it, I don't believe. So I'm sure we're going to have some new definitions coming up with credit and COVID and stuff like that. So please subscribe to all of our platforms, because we're always putting stuff out there on a weekly basis of new things that are popping up. And then we'll be doing these educational events at least once a month, if not more. So thank you all for attending. We appreciate you, and reach out to us if you have any questions. Mark, awesome job as always. Thank you very much, my friend.
Thank you all. Appreciate it.
Thank you, Mark.
Have a great day.
Thanks.
Bye-bye now.
Thank you.
Thank you.